Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, June 11th, 2025. It's 1:23 p.m. Eastern Time as I'm starting the video, so we've got a couple hours left in the trading day. And here's what I'm going to do: is start out looking at the economic calendar real quick, kind of summarize what happened or what's on there this week that could move the markets. Well, we already had CPI today; that was a non-event. Inflation came in about numbers came in about where expected, and not just from consensus, but from my CPI prediction chart. I've been using this for years, shared this with you guys many times, and been able to, with a high degree of success, figure out which of the reports are going to be market moving because we'll probably beat or miss expectations, and which ones will be a non-event. And that is DJP, which is just one of many diversified commodity indexes. And as I often say, commodities are really your only real-time inflation indicator. Tick by tick, minute by minute, second by second, you can see exactly what crude oil is doing, which has one of the biggest impacts right there behind housing. Remember, housing is lagged quite a bit, so there's no real-time indicator. You can't tell what your house is worth at this moment. You can certainly try to guess from Zillow, but then there's a reset. If the house down the street or your next door neighbor sells for $200,000 less than what you thought yours, that's going to just ratchet down that number. So again, by looking at commodities which trade virtually around the clock, and again, this is a broad-based commodity index. You have crude oil, natural gas, heating oil, you have corn, wheat, soybeans, you have industrial metals, precious metals, gold, silver, all of it's in here. And this is pretty much, again, in my opinion, by far the best way to track inflation in real time. There's no perfect thing. CPI is not a perfect measure of it. But with that being said, these are the little boxes here each month. So this is the month of May right here, this box. And you can see it was a go nowhere month. This was the month of April here. You started right there, had a big drop because crude dropped. But again, if you take just kind of a mean, you can see, from where we were, or you want to do a weighted average, you're going to be down here, and that kind of gives you an idea. So the numbers have been coming in about where they would be expected. And so again, if you zoom in here for the month of May, which was reported today, you can see it's, no big surprises there. Now, however, what will ultimately permeate into markets, and you are seeing an increase in the year over year, you can see we're zigzagging higher. It's not runaway, but inflation, at least in commodity prices, certainly trending higher for the last, year and a half after the big abatement was here. And there's a lag in the numbers in the CPI, which again, the CPI does not measure. It's not reporting or factoring in the price of bushel of wheat, the average cost in the month of May or the previous month, nor is it factoring in any of that stuff. It's the finished product. So, a loaf of bread. So wheat prices can surge. It's going to take a little while for the, Wonder Bread to pass along that price to the consumer. So, again, this is kind of a more accurate real time. And then you look at the trend. So there's somewhat of a lag as well on the bigger trend. But month to month, like I said, it does a pretty good job. So, and that's behind us. So, again, that was almost, I'd call it a non-event today. Now, tomorrow, this is the big one to watch, jobless claims here. And then you have PPI tomorrow, final demand here at 8:30. So those two have the potential to move things. And keep an eye on jobless claims. I've already commented. We can see the jobless rate clearly have turned the corner. And claims, for whatever reason, seem to be kind of, just kind of holding there. But they have been ticking. Don't get me wrong. They've been trending higher, just not as much as the national unemployment rate. And then you've got, if you really dig into the quirkiness of it, you have college grads right now double the unemployment rate in the overall economy, which is, it kind of speaks to what's going on under the hood. Again, that's only happened in recessions where a college grad rate has increased over the national employment rate. So you've got a lot of unusual things happening right now. And we also know that the bulk of the jobs have been created in the healthcare sector. Basically, we're all getting sicker. Americans are obese, and more cancer rates popping up and everything else, and aging population. And so they're creating, those are jobs that are not they're not in revenue generating jobs. You're not seeing the jobs in manufacturing and other sectors. You're seeing jobs again in healthcare, which are needed because of our aging and sickening population. But well, again, let's just watch this. It's just something to keep an eye on. And let me dive into. We're gonna get to the markets. I'm gonna do bonds right now. We're gonna look at Treasury bonds. So again, of course, TJP is something to monitor. Treasury bonds. Let's start with the long bond, because we have the 30-year bond auction coming up, and the long bond is the nickname for the 30-year. That's the longest U.S. Treasury bond now, is the 30-year. The long bond has been much more in focus, and the market's much more sensitive to it now than it has been in many years. So we'll see how the auction goes tomorrow. As I've talked about, and I'll get to again in the equity markets, there's kind of I would say right now the risks in the stock market and the bond market are nearly bilateral. In other words, just about an equal chance. When we talk about the stock market, we're within, as I've been saying for a while, spitting distance of new all-time highs. As I've said, the market, much more often than not, when it gets near there, it will pop and make a marginal new high and then correct. So whether we make one, it's almost flip a coin, it doesn't matter. There is always the possibility of a blow off top. And that's where I'm just outright wrong here. We go up, we pop, and it's more than just a marginal, relatively brief new high, followed by a failed breakout and a double-digit correction. That is, again, if that's still and has been, and long before we even got here, saying that would be the most likely scenario if this market can manage a bunch of new highs. But if it rips up, goes up 10, 20, 30% or more after breaking out, that's always a real possibility. To say otherwise would be foolish. We'll certainly take probably some technical catalysts. So let me get to the stock market in a second. So also on Treasury bonds, when you look at, again, the 30-year, it is also within spitting distance of new highs. And that's why things are going to probably move very fast. And I haven't wavered. My primary scenario is still that. I'll get to that. Markets, we're dancing. It's incredible to see how well these uptrend lines on the 60-minute charts are giving on the Nasdaq 100 futures, the S&P 500, how we're just riding up those trend lines and continuing to diverge. So there's a nice setup there. And all I can tell you is there's, a technical case can certainly be made that this was just a double top high in Treasury yields, or at least in the near term, and then we continued lower. The technical case being the big negative divergences I've talked about right here. I'm making a mess with my hand draw tools, but this is your divergent line. That was the first divergent high, first drop. There was your negative only on the PPO, and we got a nice drop, ended with a bullish divergent low. That was a technical catalyst for this ride up here off this divergent low right here. And then that sent us to test the previous multi-year highs. And again, as I've stated recently, if we break out anytime soon, we're just a bad day or two away, meaning a big move in yields from breaking that. And if right now anything could be the catalyst, but the known variables, what might be the catalyst again would be that 30-year auction tomorrow. We'll see how that goes. And that's it. So like I said, we're close there. And if this happened, if we broke out here, I would say with a very high degree of confidence, if yields break out and hit those multi-year highs, take out the recent lows right there on the 30-year, that will coincide with, it may happen, you may see the markets break down first, the breakdown in those wedges in QQQ and the breakout in the VIX. So let's roll into that. No, let's stick on treasuries real quick. I want to show you guys one more thing here. Let me find the right board. Oh, I actually believe I need to flip over to TLT. So we're looking at the long bond yield. Now we're going to look at the long bond price, TLT. And this board, it's busy, but I'm going to, bear with me. I'm going to hand draw in here what I want to show you. Okay, so let me zoom into where I need to. Gosh, I wish I could take away all these other lines here. I probably should have replicated this, and maybe I will on another board. I'll move these to a different board, but I'm just going to hand draw it in for you, and I think you'll be able to see it. So this is bonds. This was that sharp spike. This was when the Fed was in denial, inflation's transitory, and turned out it wasn't. And that was the biggest ramp up in yields in decades there, and the biggest drop in Treasury bonds, right? So that ended in the yields bottom right here. You can see the year breaks 2023, the beginning of 2024. So it was in October of 2023 right there. And then again, yields have remained persistently high. And what I want to highlight for you here, and this is making the case again, my preferred scenario, despite I'm recognizing the negative divergences, I'm recognizing the fact yields ran up and so far were rejected or pulled back off that high. But the reason I'm very much open to and actually leaning towards yields breaking out to new highs sometime soon, this is one of them right here. It's very reliable and effective. This is the PPO down here, this indicator, price percentage oscillator, very close cousin to the MACD. It's a momentum trend indicator, and it's separated by the zero line right here. And so there's multiple ways to use the PPO or the MACD. One of those, as you guys know, I do day in, day out, look for divergences, be they bullish or bearish. Positive divergences are bullish when prices are making lower lows and the indicators are making higher lows. That's positive, aka bullish divergence, and that typically precedes trend changes, i.e. rallies. When you're going down, it precedes a trend change, either a tradable bounce, rally, or a new bull trend, right? Likewise, negative divergence are when prices are making higher highs, but the indicators are making lower highs. That's negative divergence. So we're not going to talk on that right now. What we're going to talk about here is this PPO as a trend indicator. Traders will use the changes, the crossovers, the bullish and bearish crossovers between the two lines. If you look closely, here, I'll expand it for you. You have two lines here. You have a blue line, your PPO line, and the white line. That's the 9 EMA of the PPO line, also known as the signal line. And it's called the signal line because when the PPO crosses down below it, that's a bearish crossover. And when it crosses up above it, that's a bullish crossover. That in itself will often signal pretty good at predicting trend changes. And those trend changes, of course, are going to be commensurate to the time frame you're trading on. In other words, if you get a bullish or bearish PPO crossover in a weekly chart, it signals a trend that's going to last weeks to months. If you get it on the 15-minute intraday chart, it's good for active traders. A trend change, it might last for hours or days, right? So now the other way that I often will use this is the zero line. Sometimes I will look at a chart, and depending on how it's acted, I'll set my midpoint line a little bit above or below the zero line, but in this one, the zero line does a good job. And so what you can see here, there's the zero line. I just highlighted it. And I have these purple boxes right here that show when the PPO crosses over. That's when the purple box begins. That signals a trend change from bullish to bearish. So I have 1, 2, and by the way, the box ends where it crosses back to bullish. 3, 4, 5, 6, and now 7. Now this one's still current because we're still well below that, and this is what I want to focus on. But if you look above, I'm just going to box in. I've already done this, and I've shared this many times. You look at this chart and look at it with unbiased eyes, and I'm highlighting, I've got the boxes, I'm just, because I have all the horizontal lines, hard for you to see. These are the previous bullish, and guys, I'm highlighting where the PPO was below the zero line. And again, I use the signal line, which is the 9 EMA, because it's the lassitude across. And so when you do that, you tend to get fewer whipsaws. You can see without fail, the biggest drops, some of them were smaller and they were shorter sell signals, but the bulk of all these big drops were clearly telegraphed and coincided with bear trends in TLT, or the 30-year bond. Likewise, you can do it the other way. You can draw your boxes if you want on the bullish trends. It's moot because when it flips bullish, then you've got your bullish trend. So everything there, and that one was sideways. Now remember, the bigger trend has been a downtrend. This is Treasuries RN, and I've made the case that Treasuries have only begun a new secular bear market in Treasury prices, which is a bull market in yields. And I believe that will continue for a decade plus. Only time will tell. I've made that case before. And so what I'm getting at is you can't argue that over the last couple of years the trend's been bearish. That's clearly shown here by lower highs and lower lows. This price is just going down. And so what you're seeing too is the bull trends have been more muted. They've either been mostly sideways corrections, if you will, because that's typical. In a bear market, a correction is an uptrend. In a bull market, a correction is a pullback, right, or a drop. So you can see some of them have been a little better, and we've traded a lot of these. So that's the point. And now, so let me just drive the point home. This is 1,010% still clearly below the zero line without any chance anytime soon of breaking out. So that to me tells me we're in a downtrend. This trend flipped right here after this rally. I believe we caught that one. Well, like I said, one thing, if you look back or if you've been trading these, a lot of people pass on my Treasury trades. I know because I get very few, if any, comments on them. Everybody loves to comment on the stock market. But Treasuries have been a great trading vehicle. We batted probably 800 or higher on this high percentage rate, caught a lot of these trends here within the larger trend. And I just wanted to reiterate that this flipped to bearish here. We peaked here and it was a divergent high. I believe I would have identified that on the site as a short op. Even though we do have, and again, it's kind of mixed signals, just like the stock market, we have a resilient uptrend, but big divergences that continue to build. And the day that I stop believing in the charts as being a more accurate predictor of prices than anything else is the day that I ought to hang this up, because the technicals are not 100%. Technical analysis is like many things, an art more than a science, my interpretation. But right now, I'll roll into the equity markets in a second. Nothing's changed there. We're going up. We've got some uptrend lines. We've got some big divergences that continue to grow and aren't, at least at this time, are not at risk of being taken out, even if we pop to new highs in the equity markets. Likewise, you do have some divergence here. So it's possible, too, that we could see Treasury yields pop down, the divergence get extended, and then it's a false breakout here, just like the stock market. But let's see. I think we'll probably see a bigger reaction if yields break out to new multi-year highs. In other words, TLT takes out that multi-year low right there. All I can tell you definitively, I know I'm saying, well, if this happens and that happens, all I can tell you, number one, is how to react to it, what it will most likely mean. Hard to spin that a breakout into new lows in TLT. Hard to spin it as anything but bearish for the equity markets. I really, really would love to hear anyone's. I don't think you could make a valid argument if yields break out to new highs. So watch for that. And all I can tell you definitively is this trend isn't a bearish trend. Quite often when you get in there in a bearish trend, or a bullish trend for that matter, this same zero line that delineates the trends, in other words, flips, these are your sell signals here. When you flip to bearish, there was your buy signals. And what I can tell you is once you cross an inter-trend, that line will often, as it did right here, act as resistance. And it did here as well when back tested from below. And again here. So even if yields happen to go down a little and treasuries rally a little more like this, we're still, until and unless we have this clear bullish cross of the zero line, that tells me the market and the treasury bond yields are not out of the woods yet. Even though we had this little test, little relief rally, market said hurrah, yields kind of pushed it to the edge, but then boom, we rallied. So let's watch that. And all right, so I think you get the point. Drilled that in pretty good. This is IEF. This is, you might say, Randy, yeah, but the 10-year matters more. Everyone, the 10 years, what the 30-year bond mortgage rates track, not the 30-year bond. Yes, that's true. The 10-year is very important too. Same thing. Here's your zero line. Again, I've done these. You can see the purple boxes. I have a circle there. I don't know what that is. Ignore that circle. These are your purple boxes. And again, I'm just going to highlight the trends. The purple box above, downtrend, 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 and we are currently in on this indicator. It's not the be all end all, but it is in a downtrend. Last time you had a little counter trend rally within this bigger downtrend. You can see rejected at the zero line, rejected at the zero line. So unless we see the 10 and 30 years take this out, it puts the bond market in a very precarious technical posture. It has it by this one trend indicator clearly, not even, I don't have to squint to see, are we crossing lines now? Clearly bullish. And I think, in fact, I know from what's going on, when I turn on the TV or I read the headlines, the market is grossly under not pricing this risk in. In other words, how close we are to breaking those highs. And again, if we don't break out, guess what? I warned of something that could happen that didn't happen. It hasn't happened yet. But if it does happen, I believe there's the potential. I don't say this often on the site, potential for almost a crash-like scenario in the market if that starts to happen, especially if it happens and it's more than just a little brief pop to new highs on the 30-year yield, and then the 10 will follow. The 10's in a better spot. The 30-year is pricing in. Is the one testing the multi-year highs. TNX, this is the 10-year yield, has a little room to go here. This shows it to you, kind of big picture, guys. Here's the 10-year. But the 10-year is also within, we'll call it spitting distance. This is the recent trading range. So this is that spike. This is when COVID hit and they pulled out, I have no other word for it, but the all-out nuclear option with monetary and fiscal stimulus and manipulation, everything. Rates went to zero because the world came to an end. Stopped spinning for a while there when all global economies were shut down due to the pandemic, and so you had that plunge right there in yields. Everybody, the Fed bringing rates down to zero, and institutions selling stocks, buying treasuries, that caused that. And then this is where we're at right now. So, like I said, there hasn't been even the slightest abatement of yields. This, to me, is the more powerful. If my longer-term analysis of a new secular bear market or bull market and interest rates, meaning bonds going higher, is to play out over time in the coming years, I'm not talking months, I'm talking years out, 5, 6, 10 plus years. If that's to happen, this is the more bullish of the two scenarios when you have a corrective wave. When you go up in a bull market, people think of corrections in price. You pull back, and maybe we get that. Maybe we pull back and back test this. Right now, this is the stronger of the two. There's two ways for prices to correct in a trend. Either a counter trend move, which in a bull market is a pullback, or you don't pull back. You go sideways to work off the overbought conditions. That's what's happening here. From my experience, this is the more bullish of the two. So again, I can't promise, although I think this is the way it ultimately breaks. But what I can at least not promise you, but tell you with a high degree of confidence, if this is the way this thing breaks, yields break, and not this, that's going to be bearish for the stock market. And I have no alternatives there. That's I see it no other way, and I'll just be wrong if yields happen to pop, go to multi-year highs, and the stock market continues to rally. Then I'm just wrong. Everything I've ever learned in economics and finance is just kind of thrown out the window. We'll see. Now, this has actually two scenarios, and this isn't me just trying to be wishy. If we break to the downside from this recent trading range, that if it's organic, natural forces, in other words, inflation stays low, economy holds up, and we go down, yields pull back in, and the stock market's doing okay, then that is net bullish. This drop down to backtest the trend line. It still doesn't alter my longer term bullish outlook for interest rates. It just means we're going to have, the corrective wave is going to also come down in price and then probably backtest this trend line and then go up. However, there's a very good chance, in fact, it is my preferred scenario if rates do break to new highs, that then they will go down if my long-term targets on the stock market, which I have not waffled or wavered on, are hit. And if you're new to the site, on QQQ, those are on the weekly chart, board 8. These are my longer-term targets down here. It's all an extension of last year when these targets were first laid out, and it's just the way this thing's playing out. We've already hit my second target, and as often is the case, we bounced. It was a pretty good bounce, but just made a slight marginal new high. and we put in a trading range, we bounced, then we hit T3, and here we are now, and I still maintain these targets. If these targets are going to be hit, it will most likely coincide with ultimately after maybe yields trigger, maybe higher yields, multi-year breakout to new highs, and yields trigger this, get the stock market going. Whether we make a marginal new high or not, it's 6 to 1, half dozen to the other right now. In fact, coin toss odds, I told you recently, are probably above 50%. Since we're so damn close, the market will probably want to pop it. If this starts to happen at some point, especially that point of recognition, probably after the 200-day moving averages are taken out and the selling begins to accelerate down to my next target or targets, then you will see a flight to safety bid where institutions will be selling stocks and buying bonds, and buying those bonds causes the yields then to drop, right? Prices go up, yields drop. Okay, so it's not a lot of moving parts, but just understand the interworkings of financial markets. And again, things to watch. We'll watch for the auction tomorrow. And most important, it's easy. If you do this part time and you don't have time to be in front of the computer, you can set a price alert on TLT. Set a price alert to see if it takes out the recent lows. If you can do TYX, great. And that's it. And then if that alert goes off, you know that TLT is now broken out down to multi-year. And remember, it's not just multi-year lows. It'll take out that previous lows. But if I go to the weekly chart here, I turn everything off. TLT is an ETF. It's only been around since 2022, but that's going to take us back, or 2002 when it started trading. That would take us back there and potentially take yields all the way back to where they were in the aughts, early aughts, I'm sorry, or even the late 90s. That's where we're at. So that's it. And again, it's not only are we that close to it, again, just a bad day or two away in treasuries, but because of it, I think this is a point in time where the market is not pricing that risk. VIX is low. I'm not a big options fan, but if somebody wanted to put if you do use options, when the VIX is low, options you're not paying that risk premium is a lot lower. To maybe hedge up a portfolio or a speculative small position, a pure play bet that if this happens, you'd see a quick move down. Let's get to the equity markets now. So again, it's the same thing we've been looking at recently. This is the uptrend line right here off the lows on QQQ right there, the primary uptrend line. We had this first uptrend line right here, which was broken. That's when we hit T1. We hit it in pre-market on the QQQ short trade. It was put right here on the 60-minute chart. Bounced up. Here, I'll get to that one second. And then what we didn't have there on the daily chart when I laid that trade out is negative divergence, which we now very much have on the daily time frame, much more significant daily time frame. And what I'm talking about there is when we go to that trade, that swing trade was based right here off the 60-minute charts. And we did have at that point in time, it was right here, our entry point was somewhere right about here. We had negative divergence right here. And we went down, and again, it was in pre-market, so it's a little lower than this regular session chart shows. We bounced, and this is that trend line we've been crawling up. And this is, like I said, it's just doing this for a long time. This is a beautiful trend line because now look how many reactions. Look how they're dancing on it in the last couple of days. And as I often say, when you're trading on a 60-minute chart, all it really matters is how you close that candle at the end of the period. So we've had a couple these are little stop clearing punches that happen. They're called stick saves, inter-period breaks. Right now, as I'm doing this video, we have we've had 1, 2, 3, but they were stick saved. This candle right now will be finalized at in 8 minutes and at 2 p.m. And it looks like we're probably going to get it there. Let's see what it looks like on the two others that I've been following. XLK, the tech sector ETF. I gave you this one. Same thing. It's the same chart I gave you the other day. This is pretty much QQQ. It's just a more concentrated versions because QQQ are mostly tech stocks. Not in numbers. There's a lot of biotechs and other things, but the ones that matter are in here. And so you can see a couple intra-period breaks. And not much. You do have to squint to see it, but right now we're below there. We've got 8 minutes to go, now 7 on the session. And so if we get that, if it closed right here, you know, obviously the redder the better is a saying I like to say on a breakdown. If we had a big red candle like that, I'd say that's higher probability that it won't be a whipsaw. So it's simple, guys. The more you get away from that, and if we print a second 60-minute candle that's below this one, then that's going to further add to the likelihood that sell signal will stick. So that's it. So, you know, big divergence. We've been just dancing on this trend line since I gave it to you recently, and especially recently. And again, this is a momentum indicator, the PPO, and it shows that momentum has been waning as prices have been moving up. The buying pressure is subsiding, and that's what often, much more often than not, precedes trend changes. And so we'll see if we get that. You have the targets on XLK if you want to trade that one directly. SPY, told you, broke down before. It had a little bit different, had the same uptrend line like that. As I mentioned, it broke down, but it back tested. And then I said, SPY's not going to go anywhere. It cannot. It's mathematical. It's immutable fact that it has the same top holdings. It does have a lot of additional holdings in sectors that aren't in the Nasdaq 100, but because it is bound or weighted with the same market cap weighting that different. It's a market cap weighted index, meaning the top holdings: Microsoft, Nvidia, Apple, Amazon, Alphabet, Meta, Broadcom, Tesla. They're all in both indexes. And so you need to see both QQQ and SPY break down to give you a high probability sell signal. So SPY broke down, but because QQQ at the same very time was continuing to ride up that trend line like this, SPY, instead of going lower, also started to ride up, drifted up, back test. It's kind of drifting away from the trend line now and has this smaller wedge right here. So that's it. We'll see what happens, how we end the day. Let me cover a few other things for you. Let me look at, let me make sure I covered everything, one or two on, yep. All right, let's look at airline sector real quick. I want to just highlight that. XAL. There it is right here. All right, XAL, this is the Amex Airline Index, one that stands out to me right now. It's kind of like so many other sectors. Remember, only time will tell if I'm right. I know AI is a real thing, but it's not anything new, as I mentioned many times. It's just an iteration of a progression of technology, and just everything now is given the word AI. I mean, I almost fell out of my chair last night. I was reading, who was it? Okay, I think it was LVMH. Louis Vuitton, you know, the biggest, they're I believe the biggest European company, period, publicly traded, or they were, and now they're, you know, for the first time in, I think it said the article, their history, they're seeing sales drop year over year, and they've never seen that. So now they're turning to AI, and AI is going to miraculously, you know, with the marketing to customers and all this other stuff, pull them out of this rut. Whatever. Anywho, all right. So what we know is tech, you can't argue. It's a vicious cycle. The more hype there is, the more that these companies spend on it, the more Nvidia goes up, and then the more Nvidia goes up, everything else goes up, and then one day it goes the other way. All right. And I don't know any other way to explain it, that's it. And the charts will tell you when that happens. That's what we do here. What I can tell you is, you know, the rest of the world, and you can look at a lot of other sectors, you know, there's, you know, the old Dow theory says when the Dow makes new highs, so should the transports and industrials. If not, something's wrong. It's same thing. You look at other sectors, the airlines, a lot of things peaked back in 2021, like the airlines, 2022. And airlines have always kind of ground around. You never, the joke is, over long term, you never make money on airline stocks. They're great trading vehicles, but they're not good buy and hold investments. And every so often they just purge out and do a reset. They declare bankruptcy and emerge from the ashes. They keep the same name on the planes, but then they usually just stiff the stockholders restructure. But either way, we're here to talk about trading opportunities. So this is XAL, and you can see it just trades well to the technicals. That was a divergent high. They're not all labeled. You see my chart: divergent high, divergent low. There's a breakout there. Divergent high, this drop. This is a textbook right here. You can see my purple lines. That was a bear flag continuation pattern after the bearish rising wedge, breakdown right there, following the divergent high. Measured targets the widest part down to the bottom of the flag. Take that, add it to the top of the flag. There's your measured target right to the button. And we've come full circle. There's this bearish rising wedge now, complete with the requisite, or what I like to consider requisite, negative divergence. And back to the 200-day moving averages. Quick look at the airlines. And there's a point I want to make to this that reminds me a lot like the stock market right now. They had, here's Delta, DAL. Divergent, look, divergent low, mark the bottom, bullish falling wedge, rally. These are old annotations. These are old things that created back 2024 at the time in real time. This, these things trade very well to the technicals. That was a divergent high there, drop. So you can see the pattern. It's pretty simple stuff. It works out, again, not all the time, but much more often than not. Divergent high. And so what I want to point out here, and I did, there was negative divergence I had at this point back then, right here. You had a small divergent high, you had a little correction. What happened? They had one last thrust up. And again, I highlighted these. There must have been a video done because I just changed my annotations on some of these today. I dragged this. I noticed that they all went on after that initial drop, pushed up. And this is again what I see in the stock market. Sometimes after a setup like that, that's it. You go down, you don't look back. And just as often, sometimes you break down, you have an initial kickback rally that will take out the previous high. And it's actually the more bearish of the two, to be honest with you. And why is that? Because the short sellers that saw this nice little bullish falling wedge and took that short there, a lot of folks put their stops right above the recent highs. I've long since figured out that that's not where you want to put it, because everyone else, including the algos, the machines, the market makers, big trading desks, they know where the stops lay. So they can ramp it up, put in a new high, blow out those shorts, grab their shares, turn around and short it themselves, and clear out that short interest, because you can only go down so much if there's a lot of short interest in the market. Think back at the April lows recently. And so these marginal new highs like this that extend the divergence, that's what you will usually see. Shot one, divergent high one, marginal new high, then the big drop comes. And right now, Delta, no divergence yet. If it does pop this, make an equal or marginal new high here, it will have negative divergence. And I'm spending a little more time on Delta because it's one of the biggest ones. You can see that the indicators are lagging to the point that is a 100% certainty. If it's a marginal, equal or marginal new high soon, it will be the divergent high. However, it's also at nice resistance, that previous reaction high there. So it may not get there. Let me just go through a couple others. Same thing here. This is United, second largest one, had a divergent high on a beautiful uptrend line. Kind of like, remember the stock market a few weeks back? I was waiting for those initial trend lines to break to get a sell signal, and they did. They broke down, and just like now, except in the stock market on the daily, we didn't have that first divergent high. What the airlines did is they pushed in, they made a marginal new but still divergent high here to here, right? And then boom, the big drop came. And it was fast and furious, 55% in United. We've come full circle. Again, I'm sharing this not just hey, that, but also that divergent high, all right there. This one does have negative divergence right now, and a nice clean uptrend line in which to trigger a sell signal. So as I often say, and this bears repeating too, I say this a lot, but again, it bears repeating. Negative divergence is not a buy signal. I'm sorry, a sell signal. Positive divergence is not a buy signal. Overbought is not a sell signal. Oversold is not a buy signal. They are conditions. However, those things are conditions that typically precede trend changes. So once you recognize negative divergence and overbought conditions, especially in a bear trend, that's usually all you're going to get back. In a bull market, it's common to get much more oversold above the 70 level right there on the RSI. In a bear market, you're usually going to get up to about the RSI, the 70 level, and then that's it. So what is a sell signal? Once you find those conditions, this is all what this site's about. Find the conditions, bullish or bearish, then identify what's going to be your buy or sell trigger. And so in United, it's a break. Well, actually, it's a sell signal right now. I was kind of rough drawing that trend line earlier today. I didn't have it touching. This is where it should have touched all these candles here, off the lows. Boom, there's a breakdown right there. So you could take that, or you can wait for a daily close and maybe wait for Delta also to break down. Up to you. And again, I'm not going to go over each and every one of these. I just want to, this is the third largest Southwest LUV. What I can tell you definitively, big old gap there, major reaction high, major reaction high, major reaction high, major, because there were huge drops afterwards. That is a solid resistance level. Now, if it breaks it, it's bullish. Especially if it can break it and then burn through the existing divergences, then yeah, it's probably going to go up here, and that's just something else is happening. But right now, this looks like we've had a counter trend rally that's run its course in the airlines, in my opinion. And that also speaks to what's going on in the economy, because typically when the economy's booming, people are flying. I know there's been an uptick in crude recently, which, by the way, will be priced into next month's CPI. Here, let me just toggle over now. You've seen enough charts here. I made my point on the airlines and also how it kind of relates to what's going on in the stock market now. But, so the CPI was for last month. There's the month of May right here. And yeah, crude fell. It had a big drop. Crude was low. It had been hanging in this range for a while. Look what's happened. Where do you think next month's CPI is going to go in, come in at? We've had crude oil since the beginning of May right here. Shot up, and it closed a month down low, but so far in June, here, let's grab, where's June? Right there. Yeah, right here. That's the last day of May, so you want to start from there. So far, we're starting out with a pretty good bang, 11%. That's going to percolate into consumer prices because, again, fuel, gasoline, energy is one of the biggest right there. So now, there's a lot of green between now and the end of the month, meaning real estate. Kind of like, so this could come down, and then we could, but watch this. If crude continues to rally up, airlines don't like that. Sure, they use hedging, but then the charts will show you which ones were better at hedging recently than others. By that I mean, if you're not familiar, labor is the number one expense for airlines. Fuel is number two. Pretty close second too. So there's that. So airlines are both a trade idea for you. And then again, going back to, and I can hopefully wrap this up soon. This is exactly what I'm talking about here. We had that uptrend line, just like the airlines that I told you a couple weeks ago. And that's when I threw out the SPY or the QQQ short-term swing trade, but also said, look, nothing's wavered on what my plan has been. And I'm going to, as I continue to maintain, I have to see to add to long-term in my long-term accounts to add to or go to a full short position in swing shorts. In other words, to say with an increasing or a high degree of confidence that my long-term targets are going to be hit, we got to fall back below the 200 days. So right now I'm looking for, and I think even some of those that are bullish might be looking for just another pullback, and that would coincide, another correction, and that would coincide with a pullback to my second target right now. Remember, we hit T1 here, we bounced as expected, and now, as I said, we have the first, it's not much, but it's a little below the trend line there on QQQ. Oh, and that candle's now finalized. Remember, I was doing the video, told you that's it. Here's the what is that? The 2 p.m. candle's finalized. Now we're working on the next candle that'll be finalized at 3 p.m. Again, redder the better. What I want to see is obviously all the better. These don't have to happen. It just increases the odds. If we could close this candle below that previous one, again, the redder the better, meaning the deeper down. And then the end of the day, 4 p.m. Plus, then we have the jobs numbers tomorrow and PPI as well. and that would most likely either it's going to make or break this this breakdowns there. So there's QQQ, and as I mentioned, if the next leg down, because remember T1's already been hit, which opens the door, doesn't guarantee we can't hit it again and bounce, but it increases the odds because I have a check mark. This is how my trades work. Once the first target's hit and we have a reaction, that's it. It's been satisfied. That's the reaction I expect. Now, sometimes you have 3 more and then you go up and you never break it. All I can tell you definitively is, number one, if and when 50288, which was my first target, hitting pre-market breaks, that increases the odds we're going to go to my next target or targets. And if we do go down to that 4th target, as I've told you recently, which is down, it's a target zone, runs from about it's around 465 to 468. Remember what that's going to do, bigger picture. If we go down to that level right there, it's right here, it takes us back below the 200s. And then it's also very, very big support. It's what I call lights out support. I've been saying it since back here, that if we go up there, and that was my initial bounce target zone where, we covered shorts here, went long, where I expected us to go. We're certainly above there now. So that kind of puts, the longer term shorts kind of on kind of hold until we take out this level. This is what I call my lights out level. I predicted a lights out drop in the market on what I call liquidation day before Trump got to the podium. That was right here, and it did, and it was just once my lights out support was taken out, which was right there. I give it to you on the NQ futures, I believe, as well. Then we had that biggest drop in years right there. And the same thing will happen, however, much worse than liquidation day. It will shoot the odds up to probably north of 80% that my longer term and next targets on the longer term charts are going to be hit. Now, I just said a lot of things that have to happen. Some of those are predictions that probably will happen. But again, until and unless they happen, where did it go here? Weekly, some reason my annotations aren't loading. Let me try to turn this off. Oh yeah, there it is. Weekly. Yep, this is what it looks like here. Nope, wrong board. Board 8. There we go. So that's kind of it, right? Where was I? I think it's right here. Yeah, about 446. So a lot has to happen. There's a lot of real estate between where we are today. Right now, everybody's just, even the folks on TV. And again, I'm not going to argue with them. When you get that close to new highs, it looks like it's a done deal. But as I highlighted back in 2021, the Nasdaq peaked in November and came very close within, again, spitting distance. I mean, we're talking a couple percentage points of a new high. Failed to make it, and then we had that big drop that came. Oh, that was back here. So again, to me, it's going. It doesn't matter, a couple percent whether we top today, fall shy, or make a marginal new high. Anything much more than that, and this whole thing, it really just dampens the, takes those odds down to almost really low that these targets are going to be hit this year, as I expect. And so I'll leave it at that. Just don't underestimate. If you're thinking that I'm absolutely, crazy and how in the hell this is the most bullish market I've ever seen. I've done this long enough. It goes, the sentiment and news flow flips on a freaking dime. It just takes one thing, and maybe it's a catalyst, something from Trump, something to do with the trade negotiations, something to do with the Treasury bonds breaking out the new highs, or some other random black swan event. I don't know. Something's priced into the charts right now that if those things happen, Treasuries break out to new highs, would be certainly greatly increase those odds. The trend lines that I just showed you starting to crack. So the sell signals are there now. I'll bet you, 90+% of people listen to my voice will not act on those. To me, I will absolutely, in fact, I'm doing this video. I probably should have already taken it when I saw that sell signal. I'll stop the video here and take some shorts on my active trading account right now. But that's it. I just want to get that out to you. Levels to watch, things to watch for, and how to, just to more so not just the levels to watch, we're far way away from right now, at least in what it looks like, because we've been slow grinding higher. We seem like we're a long way away from taking out that kind of lights out level right here. Again, right to my fourth target zone. So this is where, if that swing trade, if this starts to play out, this is where, and this is where then you'll, oh, wow, well, maybe something else is going on. If we get down below there and you wait maybe 3, 4, 5 days, a week, you've probably missed out. I can almost assure you, if we do this, you're going to have missed out on a very objective short entry and one of the most profitable shorts in years. And again, we milked this down with impunity, even gamed that counter trend bounce. It's been a very profitable year trading the market. We gamed the bulk, or at least me personally, the bulk of that, covering shorts into and right off those lows, and stating on the morning of, no more shorts, all full long position, riding that up. Sure, this overshot my bounce targets by, to me, a relatively small amount. Relative to what? Relative based on where this thing is most likely going. So to cover here, to expect a bounce back to the 200s here and going this far, that is a relatively small overshoot from this initial expectation of this, right? Hopefully that makes sense to you. I'm going to stop it here because we're starting to get some traction on this sell-off as expected. First time in a while first time we've taken out those 60-minute uptrend lines. So that's it, guys. I'm going to get the video out to you. And listen, if you get this video and you're upset that you didn't know about it, what I say all day long, I do these videos, they're long-winded, I do them in advance. Every single setup I give you, a setup is an untriggered trade waiting for and this is really a continuation of the same trade if you're stuck with it after this, if you didn't cover on T1. But these levels are given to you in advance, never in hindsight. Once in a while, I will post a breakout of a trade that I've just come across, if and only if it's still objective. It's not too late to enter. But most of the trade setups I give you, all trade setups, are in advance. I call it trade idea, actionable trade, one that's already triggered. Maybe I showed it as first as a setup, and then I'll highlight another objective entry or add-on. So again, by the time you get this video, we could be down, close down 2% on the Nasdaq. We could be down 4 or 5 tomorrow from where we broke down here. And if you missed it, it's because you didn't set a price alert on this trend line that was given to you, as well as the Nasdaq futures. Right here, there's that same little mini wedge. This is that 60-minute chart I gave you with that secondary wedge on the NQ futures with the wedge there, and even that one starting to crack right now, as you can see right there. And actually, you know what, I'm going to pull this down. I know I'm still talking here because I need to come in tight on this and this, so it's gonna be a little bit better. And I'm gonna hold off myself until I see us take out this trend line, either on a solid intra candle basis. Remember, this is the 3 p.m. candle we're working on, so we have 43 minutes from as I speak right now. And so right now we could see a stick save here. This is why I watch both futures and QQQ and SPY and ES. So I'm gonna wait to see pretty much these lows taken out. So if it's coming into the 3 o'clock hour and we're down here, or even the 4 o'clock hour, then I will take that short that I just told you I was going to stop the video and do. So this is what I do every day in, day out. I always say the charts are dynamic, and so is my analysis. So I noted that trend line when I had a little tight, and I come in, I'm capturing these 3 most recent reaction lows. It also comes from back here further, you can see. Comes back here, captures that reaction low, 2, 3, 4, 5. And sometimes when you move the screen, look at what it did. It kind of moves things around a bit. What happened here? Oh, there it is. Yeah, it had its own little kind of brain fart when I moved the lines, but there it is. Right there, right on the line. So that's it. So if we sell into the close today, that is going to be the first sell signal that we've had on QQQ or NQ in at least the last couple weeks. And remember, again, been sharing this chart. I gave you that Groundhog Day thing the other day. Back here, I highlighted this S1 level. and we were here and said that we're not going to go anywhere until we take out S1. And that was back here when we broke this trend line and back tested it. We hit it, we bounced. So this was, as I said to you yesterday, the first sell signal that will take us down to S1. Then we need to break S1 and open the door, in order to open the door to these 4 targets I've given you on NQ. No sell signal here, we're not going here. If we don't go break this, we're not going here. Makes sense, right? So that's it. All right, I'm going to wrap the video up, get it out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.